Good evening. You're with Rebooting India. I'm Shweta Rajpal Kohli. Clearly a big surprise by RBI Governor Rangarajan today, even as he decided to hike rates at a time when most people had expected him to actually hold on to rates. So let's take a look at the big story of the day. Rangarajan deciding to hike the key rate by 0.25%, at the same time maintaining that growth will be a big worry. He says growth is expected to fall below 5% this fiscal. But the reason for the rate hike, of course, is that inflation continues to be at elevated levels. Even though we've seen inflation come off significant highs in the last 1 month, he believes that core inflation, if you leave out food and fuel, is still a big worry. At the same time, maintaining that the slowdown in the economy is worrisome. He said the current account deficit will fall below 2.5% and inflation at the end of the year could exceed 8%. Let's actually listen in to what Rangarajan had to say and the rationale behind the very surprising move of hiking rates.
The gravest risk to the value of the rupee is from CPI inflation, which remains elevated at close to double digits, despite the anticipated disinflation in vegetable and fruit prices. Moreover, inflation excluding food and fuel has also been high, especially in respect of services, indicative of wage pressures and other second-round effects. Elevated levels of inflation erode household budgets and constrict the purchasing power of consumers. This in turn discourages investment and weakens growth. High inflation weakens the rupee. Inflation is also a tax that is grossly inequitable, falling hardest on the very poor. It is only by bringing down inflation to a low and stable level that monetary policy can contribute to reviving consumption and investment in a sustainable way. The so-called trade-off between inflation and growth is a false trade-off in the long run. It is possible, I believe, to bring inflation under control without a substantial sacrifice of short-term growth, provided we do what is necessary and are patient. We've decided to increase the policy repo rate under the liquidity adjustment facility by 25 basis points to 8%. Let me first address the balance of risks that confront us in the evolving macroeconomic outlook. The slowdown in the economy is getting increasingly worrisome. Our current assessment is that growth is likely to lose momentum in Q3 of 2013-14, with industrial activity in contractionary mode, mainly on account of manufacturing. Lead indicators of services also suggest a subdued outlook, barring some pickup in transport and communication activity. On the other hand, agricultural performance so far has been robust, and the strong pickup in Rabi sowing indicates that this should be sustained. Another silver lining is the significant narrowing of the trade deficit on the back of resilient export growth. The current account deficit for 2013-14 is now expected to be below 2.5% of GDP, as compared with 4.8% in 2012-13. The recent resumption of capital inflows, with some turbulence, should help finance the current account deficit comfortably. The Reserve Bank's baseline projections set out in the accompanying review of macroeconomic and monetary developments for Q3 of 2013-14 indicate that over the ensuing 12-month horizon, and with an unchanged policy stance, there were upside risks to the central forecast of 8%. Accordingly, an increase in the policy rate by 25 basis points that we've announced today is needed to set the economy securely on the recommended disinflationary path. If the disinflationary process evolves according to this baseline projection, we believe that further policy tightening in the near term is not anticipated at this juncture. In fact, if inflation eases at a pace that is faster than we currently anticipate, and that reduction is expected to be sustained, the Reserve Bank will have room to become more accommodative.
All right, RBI Governor Rangarajan there saying elevated inflation levels hurt not only the rupee as well as consumption patterns and hit the poor very hard, but also the fact that it is something which is anti-growth. Let's take a look at how the Sensex, Nifty and the rupee did on a day when we got this surprise move on part of the RBI. The Sensex finally ending the session in the red, but if you look at that chart and notice that sharp dip that came at 11 a.m. What a sharp dip coming in just as the governor made that policy announcements, clearly indicating that the markets were not prepared for a rate hike, but the losses were recovered as the governor explained his stance and reassured that if inflation continues to moderate, there will be no more rate hikes. Similar story with the Nifty that saw that sharp dip coming in at 11 a.m. Once again indicating the shock that markets got with that surprise move, but losses were recovered with the session finally ending almost flat. The rupee meanwhile posted its biggest gain in 2 months. We've got the rupee there closing at 62.51 to the dollar, snapping its 3-day falling streak as RBI unexpectedly raised rates. But plenty of reactions coming in to RBI's surprise move. Let's listen in.
I think the governor has made it clear, that this sort of very small adjustment in the short-term rate doesn't actually mean that it's going to necessarily lead to a negative effect on the long-term rate. And more importantly, those who feel that by lowering the short-term rate, he could have given a boost. I mean, I don't think that lowering the short-term rate gives you a boost, because as he made it very plain that, banks will lower their interest rates if the cost of their funds goes down. And the cost of their funds can only go down if the rate they pay on deposits goes down. And as long as the inflation rate is a little on the high side, that's not going to happen. So I think many people think that, he could have lowered the interest rate at the short end and somehow this would have helped everybody in the industry, but that's not actually true. I think he's right to, internationally, he's right to give the signal that we are going to do whatever is necessary to A, bring inflation under control, and secondly, I think to the extent to which international capital mobility leads to volatility, he's essentially signaling that, look, we are not loosening up, so you shouldn't feel that policy is out of control. I think broadly it's the correct approach. I mean, whether he should have kept it the way it is or done what he has done, this is a matter of judgment. I don't think there was much of a case for lowering it anyway.
If the trajectory warrants, and if the trajectory shows that the inflation is falling faster than what we believe, the current belief being that there are upside risks to that 8% target, then they may actually go ahead and cut rates. So there may be room for accommodation basically. So on the contrary, what he is hinting, and there I find the commentary to be slightly dovish, that he is hinting at rate cuts if the trajectory and the factors leading to inflation show some kind of moderation.
I think what Governor Rajan has done is absolutely the right thing to do, which is to show his commitment to the objective of monetary policy being inflation. And in a country where for 4 years we've had double-digit, nearly CPI inflation has been high, you have to bring down inflation. Other countries are not witnessing the kind of inflation. The countries, even emerging markets, even those with high food baskets, are not witnessing the kind of inflation that we are witnessing. And so I think it should have been done, and I'm glad he did it.